Australia's business channel. This is Mediaweek.
Hello, welcome to the program. Ahead, 10 seeking voluntary redundancies to cut costs further after unveiling a disappointing full-year loss. 7 fires its big guns to try to keep top spot next year. And of course, we'll have all the winners from the annual Radio Awards as ads return to Alan Jones' 2GB breakfast show. But first, Nine Entertainment's been saved from administration at the 11th hour as its lenders agreed to a deal to become its new owners. The iconic broadcaster is now in the hands of 2 US hedge funds predominantly. So what will this mean for the company? Well, our co-host James Manning, the editor and publisher of Mediaweek, is here in what has been a huge week in media, but particularly the commercial free-to-air business. Just before we get your analysis on what happened, let's hear from the Nine Entertainment Company CEO David Gyngell, what he had to say when he emerged from those talks that sealed that deal.
Yeah, we got a deal. Channel 9's back.
Fantastic. What can you tell us?
It's a good deal. All the press release will be going out any minute now. But basically, Channel 9 is going to be a debt-free company, which makes it the most powerful media balance sheet in the country. So I'm incredibly proud. All those doomsdays out there are going to have to eat their words, because we've never had a more powerful balance sheet, which means that we're ready to, what I'd say, rock and roll for next year. So thank you very much.
When you say debt-free, what exactly do you mean? What deal's been struck?
No debt. No debt at all.
When you say debt-free, yeah, how's that been done?
Well, we have a fully capitalised business. Goldman Sachs receives a certain percentage of equity, which will come out in the next few minutes. And the rest of the company will be controlled by the hedge funds. So it means you have no debt. So thank you very much.
Are all the players happy with the deal?
I'm not sure if all the players are happy, but I certainly am.
And will you be staying with the business?
Yeah, of course. I was never going anywhere. That's what people like to speculate.
So it certainly seemed to come down to the wire, trying to get those lenders to agree on how they would be converting their debt to equity. But it's been done, James.
Yeah, sure. It'd be sort of, we've been following this for a long time. It'd be great to sort of spike this story for the time being. You know, there's a little bit of detail to come. In November, we'll find out exactly what's going on, the detail, but it's more or less 95.5% going to the senior lenders, if you like. Most of that debt's controlled by Apollo and Oaktree. 4.5% going to Goldman Sachs, the mezzanine debt level there. You can expect there's been some talk the management might get some sort of equity linked to perhaps performance clauses when we see the fine print, because the thing now is that they'll have to sort of work pretty hard to get this business into shape that will be attractive to another buyer, because of course the bankers and the hedge funds don't want to sort of own a TV business long term, so now they've got control of it. Be looking at a maybe 2-3 year time frame, depending on how the markets, advertising markets recover.
So the the buyer, CBC Asia Pacific, of James Packer, I mean, they pretty much wiped out their investment then in this. So Nine now debt-free, as the CEO David Gyngell was saying.
I think CBC have got a little slither of, I think there's something like exposure of $10 million there for them perhaps, but they've blown something like, you know, close to $2 billion, so it's pretty amazing. Along the way, there's been a couple of asset sales, of course. ACP magazines went on, and I think car sales got offloaded for probably reasonable money, another sort of 500 odd million plus along the way. So about $1 billion in assets got hived off during CBC's tenure, if you like.
What happens when, with the new owners? Do you think there'll be a lot of change, you know, cost cutting? I mean, obviously there's been a lot of speculation about what might happen with the cricket rights that are up for renewal after this summer.
Look, I don't think there'll be extra cost cutting. There'll be a continued focus on costs, as there are in every business, you know, but as contracts come up for renewal, they'll be thinking, look, do we really, you know, do we need this person? Do we need to be paying them that much? I don't think they'll be going through and pushing anything out of the way. They've got a pretty full offering on sports rights. You get the feeling they really do want to hold on to that, the cricket, which is up for negotiation. That's the big one, I guess. And they've done a lot to build cricket in Australia, and they're sort of linked with the sport. Would somebody else, you know, would be hard for another brand to get those cricket rights and monetise it immediately like Nine has been able to. So that'd be the thinking, you know, to make other people bidding big money, they'd have to carefully weigh that up. The biggest thing, you know, Nine's got David Gyngell back as well, because the countless hours he's spent on this debt, travelling the world, visiting, you know, potential buyers, negotiating with the lenders, the bankers, you know, he can sort of put that behind him now and really get back to focusing on the day-to-day stuff in the business, which he's, you know, become very good at.
Yeah, and obviously a great reputation in the industry.
Oh, it's really enhanced his standing for sure.
And a huge week for him, of course, as well, with his wife, the Today host. Yeah, what timing his firstborn has. All right, let's just turn to the situation, which is a bit more precarious for the third-ranked commercial TV broadcaster 10 Network, which posted a $12.9 million full-year loss today, trying to cut costs further as well, announcing it's looking for voluntary redundancies today. James, just firstly, looking at this, the overall feeling from the conference call, there was no specific interviews given, just a general conference call to analysts and media today. What was your feeling?
Yeah, look, the 10 really didn't want to have to front at all. I mean, they said there was a limit on one question per person, but a rule they didn't enforce because a couple of people got a few in. But look, James Warburton wasn't hiding. He said, look, very disappointing year. He was adamant, you know, ratings have to improve. It's a pretty simple business. You get the ratings, the revenue will follow. You know, you can have good salespeople that do the job, but the market will sniff out where you're performing well, and they'll jump all over those shows and want to buy the advertising. And that's where they're falling down. You know, they've got to front up to 1,200 clients in 5 cities next week, outlining what they're doing next year. So that's going to be a challenge, finding some stuff that's going to convince the market that they're sort of on the road to a comeback, if you like.
Talking also about obviously trying to cut those costs further and announcing as part of the review that they've done, the outcome of that, they are looking for further for voluntary redundancies. Here's what the CEO, James Warburton, had to say on that.
Today we've started to communicate the outcome of that review to our staff, and one of those key communications is a change program that we're driving through our news and operations division. Discussions around the details of that plan, as I said, are starting today with our staff, but it will involve a voluntary redundancy program. In addition, core elements include new ways to gather and present news, taking advantage of rapidly changing technology in all parts of the news process. And again, as I said, this review runs across all operations of 10 as part of the strategy to create a more sustainable business model and lower cost base. As a result of the changes in the review, our cost guidance for FY13 has been revised, as we previously stated, at mid to high single digits to an increase of less than CPI. The strategic operating and news review will not impact our investment in programming or our strategy to renew our content offering.
Interesting that they keep commenting the cost cutting won't affect their content, you know, but you sort of got to wonder about that when you look at some of the shows they've had to keep on air because there hasn't been any fallback positions. Something like I Will Survive, which, you know, any other network would have pulled it off pretty quick. And you've got a feeling that depth of programming isn't there, which other networks do have to sort of, you've got to shuffle around your hits. James talked a lot about that strategy of getting the flow right, but you've got to think it is starting to impact though on what's getting seen on air.
I guess we'll know more next week at the launches, but just also wanted to talk about the speculation that 10 might need a capital raising, and that James Warburton very definite on this, saying that that certainly is not what the company is going to do. It would have announced it. Here's what he had to say on that.
If we needed to capital raise, we would have announced it. I think in terms of earnings and the future, a huge part depends on our ratings, and as we've said, it's been a very tough period post-Olympics, and you know, we go into rate negotiations. There's good sentiment for 10. You know, people want 10 to work. People want us to restore the order in terms of being strong in the younger demographics, and really it will come down to our rate negotiation strategy, our renewal strategy, and then obviously our ratings as we go into next year. But what we have controlled and what we continue to be quite brutal on is costs, so that the upside can come and we can drive some better returns.
So interesting, of course, this all coming in the week with the iCorp sale. They say that discussions are still continuing with OMO, but at this stage, we're not sure whether they are going to be able to get a deal through.
There's a veiled legal thread in there too, and would you be saying that if you were trying to sell the asset to somebody? You know, you'd want to be treading carefully, wouldn't you? Because 3 buyers initially interested. I think APN Outdoor was in there, and JC Deco, I think, sort of was kicking the tyres. They both sort of pulled out, thought it was, you know, a bit overpriced. So, you know, and James Warburton did say, look, it's not for sale at any cost. So indicating, look, they might be prepared to hold on to it, which isn't an outcome they'd want, I would have thought.
All right, let's just get the market's view on all of this too, and we're joined by Chris Weston from IG. Chris, yeah, just certainly on and certainly what James Warburton had to say, saying, look, we don't need a capital raising. If we did, we would have announced it. What do you think of all of that?
Well, they don't need a capital raising as it stands at the moment because the iCourt deal is still being discussed. I mean, clearly, yeah, if you look at their debt position, 435 million last year, now 263 million, their debt position is improving. I think without the iCourt sale, the economists at the moment, or the market is suggesting that their debt could improve to around 229 million. So it's all about their earnings next year. If their full year debt next year is going to be around about that 229 level, it's about earnings. Macquarie have got about 50 million in full year EBITDA next year, so clearly, you know, that net debt to EBITDA level is going to be dangerously close to that debt covenant level, which has to be less than 4 times. So without the sale of the iCourt business, without like a massive kicker to grow their earnings above that 50 million or 49, 50 million level, you know, a capital raising looks like a pretty much a done deal, and I think the market's suggesting that as well. So he doesn't need a capital raising at this moment because the discussions are still going on, but if the deal falls completely through, then I think a capital raising will probably be on the cards given those metrics I've just been speaking about there.
Chris, just looking at the market caps too of the 3 big commercial free-to-air networks, Ten's now what, $450 million. Its shares have hit those new lows, and that compares to what Seven West about 1.2 billion, Nine's value, well now 2.3 billion now that deal's been done. So is Ten's stock cheap then, or what's your sort of feeling on the valuation?
Well, I think if you're a pure gambler, and you thought that the iCourt deal was going to go on, then you'd be buying the company because you're likely to see that capital raising being priced out and the stock should have a bit of a jump, but then you'd be selling it purely on the premise of its future growth. No, I mean, if you look at where the EPS is expected to be as it stands, without taking today's numbers into consideration, the consensus is around about 1.5 cents EPS. Now, if you put that into consideration with their share prices, yeah, that puts them on about 20 times forward earnings, 20 times forward PE. You compare that to Seven West on a 6-7 times PE. You compare that to a News Corp, which has had a very, very good run, still trading on 14 times. And downside risk to that EPS with the limited visibility to their growth and the ratings, which is still very, very poor. We have to see that change around. This downside risk to that EPS number. It's still very, very expensive, even at the current levels at the moment. I'd be on Seven West over 10 at the moment.
All right, Chris, thank you so much for that.